Guys, are you losing money in the stock market but still paying taxes on your losses? What if we told you there's a legal way to turn those losses into a tax advantage? In this video, we'll break down the wash sale rule and tax loss harvesting so you can keep more of your hard-earned money. Stay tuned to learn how you can use these strategies to optimize your investment portfolio and reduce your tax liability. Think you found a tax loophole in crypto trading? Think again! Unlike stocks, crypto isn't subject to the IRS wash sale rule yet. But does that mean you can sell at a loss and buy right back to lower your taxes? Let's break down the truth about wash sales in crypto before the IRS changes the rules. Tax loss harvesting is a strategy that allows investors to lower their tax liability. It involves selling investments that have lost value. This creates a capital loss. You can use this capital loss to offset capital gains. This can reduce your overall tax bill. Tax loss harvesting is a valuable tool for investors of all levels. It can be especially helpful during volatile market conditions. When markets are down, you may have more opportunities to harvest losses. Understanding the basics of tax loss harvesting is essential. This essay will provide a clear explanation of the process. It will also cover important IRS guidelines. The process of tax loss harvesting involves a few key steps. It's a strategy that can help investors minimize their tax liability by offsetting capital gains with capital losses. First, you need to identify investments in your portfolio that have declined in value. This requires a thorough review of your current holdings to pinpoint which assets are underperforming. These could include stocks, bonds, or other assets. Essentially, any investment that has lost value since you purchased it can be considered for tax loss harvesting. Once you have identified losing investments, you can sell them to realize the loss. This step is crucial as it converts the paper loss into an actual loss that can be used for tax purposes. This means selling the investment for less than you originally paid for it. While it might seem counterintuitive, this loss can be beneficial when it comes to your taxes. The realized loss can then be used to offset any capital gains you have realized during the tax year. This can significantly reduce the amount of tax you owe. For example, if you sold an investment for a $5,000 profit, you can use a $5,000 loss to offset that gain. This is a direct way to lower your taxable income. This would reduce your taxable income by $5,000. The benefit here is clear. Less taxable income means a lower tax bill. If your capital losses exceed your capital gains, you can use up to 3,000 of those losses to offset your ordinary income. This provides additional tax relief. Any remaining losses can be carried forward to future tax years. This means you can continue to benefit from your losses in subsequent years, further reducing your tax burden over time. The IRS has specific rules that govern tax loss harvesting. One of the most important is the wash sale rule. The wash sale rule prohibits investors from claiming a loss if they repurchase the same or a substantially identical security within 30 days before or after the sale. This rule is designed to prevent investors from artificially creating losses for tax purposes. If you violate the wash sale rule, the disallowed loss is not lost entirely. Instead, it is added to the cost basis of the new purchase. This effectively defers the loss until you sell the replacement security. Section 4. Cryptocurrencies and the wash sale rule. The wash sale rule has traditionally applied to stocks and other securities. However, the IRS has not yet provided clear guidance on how this rule applies to cryptocurrencies. Currently, the IRS does not consider cryptocurrencies to be securities for the purpose of the wash sale rule. This means that you can sell a cryptocurrency at a loss and immediately repurchase it without triggering the wash sale rule. However, it's important to note that the IRS could change its position on this issue in the future. It's always a good idea to stay up to date on the latest tax laws and regulations. Section 5. Practical examples, stocks and crypto. To illustrate how tax loss harvesting works, let's consider two examples, one involving stocks and the other involving cryptocurrencies. Example 1. Stocks. Imagine you purchased 100 shares of company A stock for $10,000. Over time, The stock market can be volatile and the value of your investment may fluctuate. The stock has since declined in value to $7,000. This represents a significant loss in your investment portfolio. You can sell the 100 shares to realize a $3,000 loss. This action is known as tax loss harvesting. This loss can then be used to offset capital gains or up to $3,000 of ordinary income. This strategy can be particularly useful during tax season. Example 2. Cryptocurrencies. Let's say you bought one Bitcoin for $50,000. The cryptocurrency market is known for its high volatility. The price of Bitcoin has dropped to $40,000. This drop can be quite concerning for investors. You could sell your Bitcoin for a $10,000 loss. This loss can be used to offset other gains in your portfolio. Because the wash sale rule doesn't currently apply to cryptocurrencies, you could immediately buy back one Bitcoin. This allows you to maintain your position while realizing the loss. You would still have the $10,000 loss to offset other gains. This strategy can be a powerful tool in managing your tax liabilities effectively. Section 6. Seeking expert guidance. Tax loss harvesting can be a complex strategy that requires a deep understanding of financial markets and tax regulations. It's important to consult with a qualified tax professional before implementing any tax loss harvesting strategies. They can provide valuable insights and help you navigate the intricacies of the process. A tax professional can help you understand the rules and regulations surrounding tax loss harvesting, ensuring you comply with all legal requirements. They can also advise you on the best strategies for your individual financial situation, tailoring their advice to your specific needs and goals. Remember to keep thorough records of all your transactions. Detailed documentation is crucial for accurate tax reporting. This will make it easier to track your gains and losses when it comes time to file your taxes, simplifying the entire process. Finally, stay informed about any changes in tax laws. Tax regulations can change frequently, and staying updated is essential. The IRS may issue new guidance on tax loss harvesting in the future, which could impact your strategy. Staying informed and proactive with your tax strategy, this can help you minimize your tax liabilities. If you like the video, please subscribe and drop your questions in the comments below. See you in the next video.